Good morning, everyone from New York, Midtown. This is VanEck. I'm the CEO of VanEck. And this is a pop-up webinar that I'm doing with Matthew Sigel just to discuss the Bitcoin 2024 conference that was in Nashville this past weekend. I'm just going to make some introductory comments. Matt's going to go through some very interesting slides, and then we'll open it up for Q&A. My just overall observation, I do macro outlooks for the firm. I just updated our Q3 outlook last week, so that's available on YouTube and our website, vaneck.com. I won't get into that now. Since March of last year, I was pounding the table on gold and Bitcoin for macro and fundamental reasons, and I think they continue. That's not to say we can't see 20% corrections. And we have over that time period, but overall we are bullish, or I am bullish on Bitcoin. The one point I just wanted to make before turning it over to Matt is that blockchain software, or like Bitcoin, changes over time. Its capabilities, its users, its functionalities, a lot's changed even over the last 14 months, which we'll get into. But in order to understand the risks and rewards of investing, you have to understand something about the fundamentals. And I'll just do a shout out to Matt, who does frequent content contributions on our website and on social media about the changes that are happening on chain. Like I oversimplify, Bitcoin's a network, and if no one's using the network, there is no value. So he does a monthly chain check research piece, which I think dips into how usage is changing over time. All right, Matt, over to you. What happened in Nashville?
All right. Yeah, Jan, thanks for the handoff, and thanks everyone for joining. The VanEck team spent a few days at the Bitcoin Nashville conference last week. We had a booth. We handed out a bunch of swag. We hosted a dinner, which included reply guys on Twitter, VIPs, a great community. So please reach out at the next conference. And Jan, you mentioned that you've been banging the table on Bitcoin, and digital assets team has been grateful beneficiaries of your conviction. One nugget that you put out there on your speech was your personal allocation to Bitcoin at 30%, which is very high. And I thought maybe you could just elaborate a little on that, how you see that allocation, how it's changed over time. Is that all from price appreciation? Maybe just a little more color, because it was a big number that got people's attention.
Yeah, I don't know why it's not really that surprising. I didn't mean it to be surprising. And I kind of didn't say it, but I really meant it to include crypto overall. And as I said, that's the floor. I didn't say what my exposure was. I think one of the big topics about Bitcoin in the investment community is really how much to allocate and how to allocate. And we'll talk about that later on, correlation, volatility, all that kind of stuff. But I guess, the idea that struck me coming from the conference, Matt, is, to me, I see Bitcoin as some big thematic trend. And what I don't want to do, I see that happening over a multi-year period, is sort of sell into that trend unless I really think that prices are overextended. So there's this sort of core portfolio, let's call it, that I and other people would have for retirement or college education. And that's not at 30%, right? That's more in the 2 to 5% range. But I do have, I'll call it play money or other money, and I have this conviction about Bitcoin. And I think the worst thing, and no one really does this in the community, I don't think, which is why there are so many people who own millions and millions of dollars of Bitcoin.
All right, so I'm going to give a little roadmap for today's presentation and then run through the slides. Basically, our key takeaways from the conference: Bitcoin's gaining prominence in the mainstream. 2 out of the 3 presidential candidates attended. Emerging markets adoption is accelerating, and we have some news flow on that this week I'll get into. We did some research on Bitcoin's scarcity characteristics versus other reserve assets. And we also recently released a model with a scenario in which Bitcoin Bitcoin becomes a reserve asset used in global trade. And under that scenario, and I'll walk through the model, we get to approximately a $3 million target for Bitcoin price in 2050. So I'm going to start with some of the comments from Donald Trump's speech, which personally I found to be undercovered in the mainstream media, but we think it's a major change. He said that Bitcoin probably overtakes gold. He meant by market cap. There was a huge cheer from the crowd with the quote, "I will fire Gary Gensler on day one." He said that the U.S. government violated the cardinal rule, which is never sell Bitcoin, which is what Jan just said. He described Bitcoiners as high IQ people and said that we saw inflation before anyone else. He astutely observed that the danger to the dollar comes from Washington, not Bitcoin. We agree with that, given the fiscal recklessness. Promised to immediately shut down Operation Choke Point 2.0, which has made it hard for banks to bank the crypto industry. Promised to sell a strategic Bitcoin, to create a strategic Bitcoin stockpile, although there were not details on that. It was more like promising not to sell the roughly $13 billion that the US government holds of seized Bitcoin. He promised to enable safe, responsible expansion of stablecoins, which will extend dollar dominance. And importantly, he tied the issue to energy, promising to create so much electricity that we will all be begging that we don't want any more electricity anymore. And then there was one kind of warning shot. It was unclear if he was talking about Kamala Harris or himself, but made a joking comment of, let's be nice to the Bitcoiners, at least until after the election. So I think that's a question mark as to how much of these campaign promises into real world changes, but certainly very encouraging speech, and price of Bitcoin rallied in the aftermath of that, reaching 70,000, where there was a significant amount of selling. Some other news that we took away from the conference, Proton Mail, which is an encrypted email service that is widely used by journalists for anonymous sourcing. They launched a Bitcoin wallet, so that reinforces, in my mind at least, the connection between censorship resistance of information and censorship resistance of money. Lightning Labs released a new protocol called Taproot Assets, which will basically enable stablecoins on top of the Lightning network. And as we show from this chart here, Lightning's network capacity has recently reached an all-time high, both in Bitcoin-denominated terms as well as US dollar-denominated terms. Jan and I were speaking before this that we definitely felt a lot more Bitcoin Layer 2 presence at the conference than last year, given it's been about a year since Ordinals, which is an NFT protocol on top of Bitcoin, was released. And then Marathon, the Bitcoin miner, who's promised to buy 100 million of Bitcoin. The Bitcoin miners have much improved balance sheets now versus a year ago.
And Matt, could I just interrupt you for a second? First of all, you might want to change the display on your PowerPoint, because I can see the whole thing. But there we go. I think what I wanted to kind of ask you to kind of explain is what functionality in non-jargon terms has changed vis-a-vis Bitcoin. So we know that it's a way of transmitting value from one person to another, namely transferring Bitcoin. But what do you mean by Lightning, and what's all that stuff?
Sure. So as you have observed many times, users don't really want to use a payments network where the fees are incredibly volatile. If it's costing you $100 to send a transaction one day and $10 the next, that's not a very predictable user experience. And many blockchains are plagued by that dynamic. So in an attempt to scale these open source blockchains and make the user experience more predictable, there have been a number of so-called layer 2 blockchains that are built on top of Bitcoin or built on top of Ethereum that it introduce various trade-offs. The positive is lower transaction fees and faster confirmation times. The negatives are that these layer twos can introduce more centralization into the protocol and kind of leak value from the main chain. So over the last year, thanks to some innovations on the Bitcoin blockchain, there's been a proliferation of layer twos, one of which is this Lightning Network, which is kind of the OG of Bitcoin layer twos. But we recently released a research piece. We counted more than 20 of these Bitcoin layer twos that are trying to onboard Bitcoin from big holders and then offer either a side chain or a separate blockchain that can allow kind of faster, cheaper payments. None of these layer twos have found extreme product market fit yet. They're still in the early stages. And I would note that something like Lightning is basically not usable in New York because of regulatory objections. So there are a lot of kind of hurdles to mass adoption in the US. But as you can see from this chart, the momentum is up and to the right.
Thank you.
Yep. Over the last 4 years, we've been talking a lot about Bitcoin as a reserve asset and its potential adoption by nation states and pension funds. It's been encouraging over the last week to see 2 additional pension funds, the state of Michigan and Jersey City, announce plans to buy Bitcoin. So this now we've got 3. Wisconsin was the first a couple months ago, and we think that's going to grow. This year, there have been 3 additional countries, Argentina, Ethiopia, and Kenya, that are now sponsoring Bitcoin mining from the central government level. And this chart shows on the x-axis is the timeline. So Bhutan was the first country, very, very small. The circle is the size of the economy. The y-axis is the size of the investment. So over the last 3 years, the economies that are dabbling in Bitcoin mining continue to get larger. The size of the investment continues to get larger. And Argentina was a big one. Their state-owned oil and gas company has now promised to mine cryptocurrencies using stranded oil and gas reserves.
The reason I like this slide, or at least I asked you to put it in, is many people have been saying, okay, foreign central banks buy gold. They've been buying a lot of gold in the last several years. When will they be buying Bitcoin? That may be asking the wrong question, right? A country can also get exposure to Bitcoin, as the slide indicates, by mining it. But anyway, we'll see if the United States ever does anything. I think the big picture here is that would be a huge leapfrog in adoption if suddenly, one of the world's superpowers started building a strategic reserve.
Yeah, I think one of the takeaways from this slide, of the 7 countries on here, 4 of them are basically in default or in negotiations with the IMF over an injection of capital or kind of refinancing these IMF loans. So countries like El Salvador, Argentina, Ethiopia, and Kenya are using Bitcoin mining to access hard currency, so they can sell the Bitcoin for dollars without anyone's permission, and they're using it as a negotiation tactic versus the IMF. And actually, there was a story today. So Russia this week passed a law that makes crypto legal for cross-border trade. And then there's a headline on the tape that El Salvador wants to use crypto as well with their Russian trade. So there are annual surveys by the World Gold Council that ask central bankers specifically, what are your plans for gold buying over the next 12 months? And you can see the percentage who are planning to increase has gone up from 8% in 2019 and now is at an all-time high of 29%. So the de-dollarization strategy, or rather a theme, we think is accelerating. And when you ask these countries, why are you planning to buy gold? they typically say, long-term store of value, diversification. Uh, Very rarely do they admit, sorry for this vertical line, but the field all the way on the right here says part of a de-dollarization policy. So very explicit kind of middle finger to the US dollar, and 13% of the emerging market recipients admit that the buying of gold is an explicit de-dollarization strategy. Only 6% of developed market central banks admit to that. And I think that jives with this slide, which is that it's really the EM and frontier countries that are looking to gold, and we think Bitcoin most aggressively. So here we've done an exercise to try to compare Bitcoin supply to gold supply. So the dark line is Bitcoin, the light line is gold. Each of these fields will add up to 100%. And some of the observations that we take away from this chart, which breaks Jan's rule of having more than one line per chart, sorry about that. The economically mineable gold, the gold that is expected to be mined over the next decade or so, is roughly 20% of the current supply. So gold mining kind of grows at like 1.5 to 2% a year. So over the next decade, roughly 20% of the current supply will be mined. Compare that to Bitcoin, where it's less than 6%. Bitcoin already is held by ETFs in a much larger percentage than gold. So ETFs hold 3.5 times more of a share of Bitcoin supply than they do of gold supply. It's roughly 5% versus 70 basis points. So the ETFs have had strong success already. And when I ask myself, why are ETFs like more represented in Bitcoin than they are in gold, what stands out to me is this government field. So governments own almost 14% of all the gold outstanding versus 2%, 2.5% of all the Bitcoin outstanding. And if we're correct, it's going to be emerging markets that will begin buying Bitcoin or mining a coin for their state reserves, and this kind of arbitrage will begin to close. But one thing that is notable in gold is 30%, which is held for jewelry, and another 10 or 12%, which is held for industrial use. This type of use case doesn't really exist for Bitcoin. Jan, when you see this chart, what do you take away from it?
I love the unmined part and the supply that's coming on stream over the next decade. I think the number for gold is surprisingly high.
Yeah. Our emerging market debt team has been very active in collaborating with the digital assets team to explore some of the implications of these kind of emerging markets that are mining Bitcoin, and we've held some of the debt of these countries. I just wanted to make a simple observation that when I put the sovereign debt of El Salvador, Argentina, Ethiopia, Oman, and Kenya, which are the 5 countries that do have kind of publicly traded debt, 4 of the 5 have outperformed the EM index over the last 3 years. So whether Eric Fine, who runs our EM debt strategies, has been making the observation that emerging market central banks have run more orthodox monetary policies over the last few years. That may be one reason why their debt is outperforming. But we think that the willingness to even consider Bitcoin as kind of a check and balance on fiat monetary policy perhaps gives the market more comfort in these sovereign issues. So we are keeping an eye on this, and we'll have more for you on that. Okay, so next part of the presentation is getting into our Bitcoin 2050 scenarios, and we published a piece last week. The conclusion of the piece, given geopolitical instability, the waning influence of traditional economic powers, we wrote the piece to illustrate why Bitcoin's fixed supply decentralization, and energy intensity may make it a candidate for one of the global reserve currencies of the future. And we ran some future assumptions. We assume that global GDP grows at 3%. We assume that global trade grows slower than GDP, so that we're in kind of a continuing deglobalizing and isolationist backdrop. And then we introduce a gradual penetration rate whereby up to 10% of global international trade is settled in Bitcoin, up to 5% of domestic trade settled in Bitcoin. Central banks introduce over time a 2.5% weight in Bitcoin versus their 22% weight in gold currently. That will take more Bitcoin off the market. So currently about 30% of Bitcoin is unmoved in the last 5 years. That number is going to rise and approach 85%. And then we do a velocity of money calculation, dividing our estimates of Bitcoin denominated trade by the circulating supply, and arrive at a price of roughly $3 million per coin, which would represent 1.5% of the world's financial assets. We estimate Bitcoin's about 10 basis points today. And lest that 2.9 million figure scare you off, it equates to a compound annual growth rate of 16% through 2050. For perspective, our medium-term target of 325,000, which is half the market cap of gold, is about a 32% CAGR. So it is a significant deceleration, but it introduces kind of a 0 to 1 moment whereby governments and multinationals begin actually using Bitcoin to settle these international transactions. And that hasn't happened yet. There's news today that El Salvador and Russia may begin such an endeavor, but that's the call. And the analysis is based on a strong correlation that we found between the relative GDP of a country and its the global usage of its currency. So it's intuitive, I think, that larger economies tend to have more widely used currencies because they have higher volumes of trade, investment, and financial transactions. But when we look at the current state of the world here in 2024, we're somewhat surprised that Japan, Europe, and the UK still, those three currencies comprise about 30% of central bank reserves, but they only comprise about 23% of global GDP. And when we look at the demographics of those countries, their economic policies and energy resources, we expect that the relative GDP of those three, Eurozone, Japan, and UK, will continue to fall pretty precipitously, and the US dollar ratio will fall somewhat slower. And then Bitcoin will emerge here at the top of the chart to grab 2.5% share. And we debated these internally. There's differing estimates here from different teams. Some thought that our RMB estimates, where we have the RMB growing from 1.8% share of international reserves to 12.5%, might actually be too aggressive. China's share of RMB usage has doubled just in the last year to roughly 4%. But if you're even less bullish on China and more bullish on gold or Bitcoin, then you could argue these numbers could even be conservative for Bitcoin.
I would just invite people. I don't think it's a surprising conclusion to say if central banks start buying Bitcoin, the price is going to go a lot higher. But not many people have put down their assumptions in writing. So I would just say, if you have thoughts on this, please engage us, email us, call us, tweet at us, whatever assumptions you find to be reasonable. Even internally, we've had some good discussions. But let's move, Matt, so we can get to the questions.
Okay, yeah, this is the full model, which I encourage you to take a look at. But base case 10% of international trade, 5% of domestic trade, bull case 20 and 10. But yeah, please look at that. This is just my guiding light for Bitcoin, which very large sample size survey across a dozen plus countries. It asks very simply, are you optimistic, pessimistic, or neither on Bitcoin? And for me, it's a demographic story. Countries on the far right, France, Germany, Japan, these are kind of the oldest countries in the world. Countries on the left, Nigeria, India, Vietnam, these are the youngest. And I think that's a great kind of mental model for where the adoption is going to come from, that ETFs in the US unlock kind of the speculative utility of Bitcoin for both institutional and retail investors. But in these emerging markets, they're looking at the utility, the ability to self-custody, the ability to work outside of the confines of the US dollar. This is a look at Bitcoin's scarcity relative to other asset classes. So the bars are simply the expected additional supply of U.S. government bonds, gold, and Bitcoin in billions of dollars over the next 10 years. And you can see, 20 trillion of US bonds that are coming to market, 2.5 trillion of gold, $62 billion of Bitcoin. So this is how you end up with the type of parabolic returns that we've seen in previous cycles.
That's a very depressing slide. Thanks, Matt. I was enjoying my morning.
This is a snapshot of who holds the Bitcoin ETFs after 1 quarter of trading. And I think the largest circles on this chart for me are remarkable, that 85 hedge funds own $5 billion in Bitcoin ETFs, 405 investment advisors own $2.5 billion. If you think about the AUM for these cohorts, investment advisors manage about 20 times the assets of hedge funds. So I think you can really see from this that the early buyers of the Bitcoin ETFs were hedge funds who were trying to front run the kind of systematic allocations that investment advisors, may make. But since we have not really seen the large bank-owned brokers release their asset allocation models that include Bitcoin, some of these advisors have not enabled their advisors to allocate to these ETFs on a discretionary basis. That this number has been slow to grow. My prediction is that when we look back on this in a year, the RIAs will own 3 times the amount of the hedge funds. So we think these models are coming, and that'll be a second half story. Just highlighting that the ESG objections to Bitcoin appear to be waning. We've seen some natural language processing analysis of the Bitcoin mining industry, at least how it's been covered in the mainstream media, and the sentiment has improved. There's less of a focus on Bitcoin's energy intensity. Part of that may be because Bitcoin's now 63% powered by sustainable or renewable energy. So we're encouraged by that. ESG flows have been negative all year. We think that's probably a tailwind for the asset class. And just the final quantitative snapshots here. If there is a common objection to Bitcoin or crypto allocations from institutional investors, it would probably be that Bitcoin's correlation with tech stocks is worryingly high, or that at least it was worryingly high in the 2022-2023 cycle. We're running these numbers every month, and the data shows that the correlations remain very, very low. So 0.19 for the S&P, everything else is less than 0.1. And then here is a time series. It's the simple daily correlations, Bitcoin, NASDAQ, hanging at that 0.2 level. So above where it was in the first half of its existence, but kind of similar to gold in the current level. This is a survey. My thesis on this asset class is that investors who own uh, more than 10% of their equity portfolio in kind of Magnificent Seven or US tech are looking for hedges on that exposure. This chart from Deutsche Bank asks institutional investors to rate various asset classes from 0 to 10, where 0 equals no bubble and 10 equals extreme bubble. And it's 3 different times: January 2021, March of this year, July of this year. You can see how the Magnificent Seven bubble rating has been increasing. It's now at 7.8. Bitcoin's bubble rating has been decreasing, and institutional investors now see a bigger bubble in the Magnificent Seven and equal in US tech equities as they do in Bitcoin. I think this is a sign that investors are open to Bitcoin and Ethereum as the ultimate hedge. For Bitcoin, the hedge on fiscal recklessness, and for Ethereum, the hedge on the unsustainable profit margins of Google, Apple, and other centralized tech companies. This puts some of our price scenarios into context. Bitcoin at 100K, a $2 trillion market cap would be equivalent to the KBW Banks Index. That'd be an 8% CAGR through 2030. This is our price target, that kind of 325, 350, 6 trillion, half the market cap of gold. That would be a 30% CAGR. And then for ETH, our recent research piece was a $22,000 valuation for ETH. That would put it roughly at a $2.5 trillion market cap, which would be the same as Google and equate to a 35% CAGR by 2030. So these numbers are, not that different from what investors have become kind of accustomed to with big tech. We like the fundamental story for these assets better, growing faster. Just highlighting some of the research that we've put out. I've been to El Salvador twice, wrote this piece now 3 years ago about how sovereign adoption of Bitcoin is actually the ultimate ESG strategy. And then Eric and Natalia on our EM debt team have been writing about the scary phenomenon of fiscal dominance when a country when a country's interest payments begin to grow at an unsustainable rate, and some of the distortions that has on monetary policy and government bonds. So please subscribe to our research, or if not these funds, for further information. Okay, so the key takeaways here: Bitcoin continues to gain prominence in the mainstream politically, but also specifically in these emerging markets where adoption appears to be accelerating. We are bullish on Bitcoin because its scarcity stands even more notably compared to gold and other reserve assets. And we see a credible scenario if Bitcoin can be used in international trade to achieve $3 million per coin. And with that, I'll take any feedback or questions.
Yeah, Matt, I'll throw some questions your way. Just invite. Thank you for the presentation. Very very thorough. I'd invite listeners, if you have a question, just to pop that question in Q&A, and then we'll wrap up. But I guess the first one: is there a way to participate in the layer 2 side chains? Like, I don't know if this question is accurate, but like Taproot or Enduro?
There is a way. Many of these Bitcoin L2s have test nets where users can get on board and play around with building functionality. Many of them are looking for Bitcoin that investors will lock up on their protocol in return for some kind of yield. There's no real systematic way to get involved here besides kind of doing your research and getting involved on the Discords or on social media. This piece that we put out on Bitcoin 2050 includes a table of the top 20 or so Bitcoin L2s. So I'd encourage you to take a look at that list and look at the ones that have attracted the most Bitcoin TVL, total value locked. They're likely to have the most engaged ecosystems at the beginning. I
Thoughts
see
on
this.
Monero?
Yeah.
I'm going to skip that question because I think we generally don't, we publish our research. We don't have research on Monero, and we don't want to share opinions on everything in the crypto world. But let's get back to this theme of the Nashville conference and Trump and the politicization of crypto. So maybe I'll take a step back and just give, I think, the view in the crypto community that Trump's endorsement of Bitcoin and advocacy for regulate regulatory clarity. That's not the right phrase, but hopefully you know what I mean. Clear regulations when it comes to crypto, generally speaking, has started to impact crypto prices over the last month or so. So specifically, the question is, what if Trump doesn't win? Is that a negative price on Bitcoin? And then maybe what about Ethereum and other crypto assets?
My take is that Kamala Harris is bullish for Bitcoin, simply from a fiscal kind of position that both candidates are going to have similar fiscal policy that reinforces the unsustainable nature of our deficits. But if Kamala Harris wins, it probably means that Bitcoin dominance goes higher. Because if she continues the same regulatory stance as
What's Bitcoin dominance?
Bitcoin dominance is Bitcoin market cap as a percentage of total crypto market cap.
So Bitcoin goes up, Ethereum maybe not as much, and other tokens or blockchain software definitely not as much.
Exactly.
And that's what's defined this bull market, right, over the last year or so, pretty much.
Yes, Bitcoin dominance just made a fresh all-time, not all-time, but 52-week high on Sunday of 56% on the back of the Trump Bitcoin Reserve announcement. And I think it probably that dominance also reflects some the weakening Trump odds over the last week.
Got it. So we're bullish on Bitcoin over the next year and gold, but it's more if Trump doesn't win, our view of other assets will be less positive. Great. Next question. Following the Biden administration's vetoes of SAB 121 and the FIT Act, well, I don't know about that. FIT passed the House, right? And it didn't get to Congress. I did the Senate, I believe. But are you equally bullish on Bitcoin or crypto under Trump or Harris administration, or is there much less optimism? In other words, I guess there was a lot of evidence of bipartisan support of some of this legislation in Washington that I think got people very excited. Do you, after the election dies down, do you expect that to reemerge in terms of legislation in 2025?
Yeah, I think under a Harris presidency, it will depend on if she replaces the SEC chair and sets a clear public difference between herself and the previous administration. Under a Trump administration, like he already owns $5 million of Ethereum. He has a very successful NFT collection and has indicated, strong desire to let creativity figure this out, let the free market figure it out. So I think Trump would be much more bullish for altcoins like Ethereum and Solana, but I don't want to make it too binary. I think one of the themes of this presentation that we just gave is that this is emerging markets asset class, the frontier markets asset class. There are not too many Americans who are clamoring to get on chain and start using stable coins instead of Venmo, Zelle, Cash App, and their regular online banking, because we're spoiled for choice in America. So we need to kind of check our own financial privilege and realize that there's a billion people living in countries with inflation problems who do have a desire to transact, from a self-custody perspective and use stable coins. And you could even argue that if a Harris presidency, to the extent it continues the divisive foreign policy of the Biden administration, may actually catalyze more Bitcoin adoption if the de-dollarization trend were to accelerate.
Matt, your price projections are based on an adoption model, I'll call it. There are other models out there like stock to flow and the power law. I'm not sure I know what that is, indicating a price target of 400,000 to 600,000, which is one standard deviation above trend this cycle, which is defined as the next 2 or 3 years. I assume you don't find value in those models, which is why you don't reference them in your research, but maybe you want to comment on that.
Yeah. Well, the 2050 model of the 3 million is a velocity of money equation, kind of MV equals PQ equation. So we're not looking at the market cap of some other asset and saying it should be X% of that other asset. It is trying to do a utility-based model. Whereas in the 2030 $325,000 projection, we are using that like benchmarking uh, process. So looking at gold and what percentage of gold's market cap could Bitcoin achieve. And I think that one, the 325, is more of the speculative approach, just benchmark it to another asset. We don't need necessarily to have the global trade functionality enabled to reach that 325K. It's just about enough people thinking that Bitcoin is digital gold. The 3 million price target, you actually have to have them using it. I'd say that's the difference.
Well, I'll look forward to tracking that through your monthly research. Okay, last question. Oh, no, not the last question. How do you, well, I think maybe referring to your Ethereum research might be helpful in answering this question, but it's the balance of economic value for the settlement layer and these layer twos, right? So I guess you can answer it in the Bitcoin context if you feel like you have enough information, but maybe just talk about your Ethereum, the conclusions of your Ethereum price research.
Yeah. So in both of our deep dives on Bitcoin and Bitcoin L2s and ETH L2s, we come away less bullish on the market cap of these L2s. So these digital platforms have very strong winner take all characteristics, and we've not yet seen the stickiness of some of these L2s. The money tends to be very high velocity, willing to change and move around in a way that is not the case on the L1. So in each case, for Bitcoin L2s and ETH L2s, we have the total market cap of all the different L2s equaling only about 15 to 20% of the market cap of the base asset. And for many of these L2s, for ETH, we have a large sample size. There's very high inflation in these projects. So their circulating market cap right now is only about 20% of the total market cap, which means 80% of the tokens have yet to be printed. And that's could be pretty big headwind on the token price.
Almost like an anti-Bitcoin approach, right?
Exactly.
Too much coming supply as opposed to a limited supply.
Exactly.
I think we'll bring it to a close. There's a question about whether Bitcoin could flip gold because it's programmable, but I think you've kind of answered that in your discussion of its functionality and its adoption through your price model. And then, people would love to hear more about our views of stock to flow. Understood. We'll keep that in mind. But Matt, thank you very much for walking through I think, and marking to market sort of what happened in Nashville, and also, your thoughts on Bitcoin adoption today, and how that might grow. Because I think it's very important for investors to understand not just the macro outlook, but also the fundamentals of what's happening on chain. And even though it's all transparent, literally, for people to look at, there's not a lot of translators of that adoption into kind of consumable format, and that's what we try to do. So if you have questions, email us at info@vaneck.com, or reach out on social media and our website. We can actually share these slides. Thanks for listening today. And thanks again, Matt.
Thank you. Thank you, everyone.